Hi candidates, welcome to another session of Manifested Online classes. We are still soldiering on with our syllabus coverage, and in this session, I want us to continue with the topic of reconstruction or reorganization of the company. In our first and the second session of this particular topic, we looked on what is reconstruction or basically the organization of the company, and also we looked on the two ways in terms of how the company can reorganize or restructure its operation and also the capital structure. We started by looking on what is known as internal reconstruction or capital reduction. We looked on the accounting entries which are made as far as that is concerned, and also we did a past paper illustration question. So in this session, I want us to continue and look on the second type of reconstruction, that is the external reconstruction, and also something which is known as merger. So the reason why we're looking on merger and external reconstruction together, we are covering them together, is because from an accounting point of view, how merger and external reconstruction are accounted for, they are accounted for in the same way. So, but what is the difference between the two? So let's start by defining what is external reconstruction. External reconstruction. Reconstruction. So what we mean by this is that the company which has been making losses, or basically a company which has been experiencing financial distress for a number of years, that company will be liquidated and a new company will be formed to take over the business operation, asset and liabilities of that company which has been liquidated. So maybe say a company A here, this company has been experiencing financial distress. It has been making losses for a number of years. The shareholders of this particular company and the directors will sit down and they agree to register a new company, say company B, and this particular company now, which has been registered, will take over the business operation, the asset and liabilities of this company which has been liquidated. That's what we mean by external liquidation. You can see the external reconstruction, that is, you can see that company is liquidated, and then a new company here will have to be formed to take over the operation, asset and liabilities of that company. So therefore you can say external reconstruction. This is where an existing company which has been making losses, and experiencing financial distress, will be liquidated, and its business operation, assets and liabilities taken over by a new company. Taken over by a new company. That's what we mean by external reconstruction. What about merger? So when talk about merger, equally this whereby we have two or more companies which has been making losses or experiencing financial distress for a number of years. Those companies will be liquidated, and basically their operation, asset and liabilities taken over by a new company which will be formed for that purpose. Let's assume that we have company A and company B, and these two companies, they have been making losses for a number of years and also experiencing financial distress. Now, the owners of these two companies, or basically the shareholders of these two companies and the directors, can agree to do what? To liquidate the two companies and then register a new company, say company X here. And once that company has been registered, it will take over the business operation, the asset and liabilities of the two companies which have been liquidated. And therefore, you can see there is a kind of a similarity between external reconstruction and merger. So the similarity is that under both merger and external reconstruction, we have a company or companies which are liquidated, and also on the other hand, we have a new company which is formed, or basically which is registered to take over the business operation, asset and liabilities of the company or companies being what? Liquidated. That's why we have said from an accounting point of view, merger and external reconstruction are accounted for in the same way. So, but even before we proceed to look on the accounting aspect, we can first of all define what is merger. Merger, which is also known as amalgamation, and we can say that this where two companies are combined. This is the combination, of two or more companies, companies to form a new company, So what that means that in case of a merger or amalgamation, the companies which are combining, we are saying the identity will be lost, assuming it is a company A and company B which are merging. Then you are saying the identity of these two companies will be lost, or in other terms, these two companies will be liquidated, and a new company, say company C, will be formed to take over the business operation, asset and liabilities of these two companies which have merged, and which by the end of the day have been what? Liquidated, because we are saying by the end of the day, the identity of these two companies will be what? Will be lost. Now, what we have said is that in terms of how we account for the external reconstruction and merger, we account for them in the same way. So we can say, we can have a note here and we say both merger and external reconstruction are accounted for in the same way, in the same way. So before you look on how we account for this for merger and external reconstruction, I want us to look on some of the differences between external reconstruction and internal reconstruction. Differences between internal and external reconstruction. External reconstruction we can summarize these particular differences in a table where we have internal reconstruction and external reconstruction. External reconstruction. So we have a number of differences here. One of the differences is that the internal reconstruction, which we also refer to as a capital reduction, we say these require a court approval. So we can say court approval is required. Court approval is required. Before the company can undertake internal reconstruction or capital reduction, the company need to get an approval from the court. But under external reconstruction, court approval is not required. So the other difference, number two, is that in case of an external reconstruction and also merger, we have said there is a new company which is formed, but at the internal reconstruction, no new company which is formed. So we can say a new company is formed, and we have said that this new company is formed for the purpose of taking over the business operation, the asset and liabilities of the company which has been making losses or experiencing financial distress. And then here we can say no new company is formed. No new company is formed. That is basically the other difference. The other difference is that in case of external reconstruction, the assets and liabilities, of the old company or the company which has been making losses or experiencing financial distress are transferred to a new company. Are transferred to a new what? Company. But in this case, we don't have transfer, no transfer of assets and liabilities. No transfer of asset and what? Liabilities. Under the internal reconstruction, or basically the capital reduction, we are saying no assets or liabilities which are transferred, And then the other difference, we say that in terms of how internal reconstruction is undertaken, so this is a little bit slow and tedious. Because these need to get the approval of the shareholders. The company need to get the approval of the court. So that particular process becomes a little bit slow because of all those particular approval from the shareholders, from the court and so on. But this one we say can be carried on easily. Easily. So that is the other difference. The other difference we can say in case of internal reconstruction, there is a capital reduction. Or basically the capital of the company is reduced, but here we don't have a capital reduction. No capital reduction. So these are some of the differences between the internal and also what if is the external reconstruction. So you may come across such a question whereby the examiner is requiring you to differentiate between internal and external reconstruction. So from there, once we proceed and look on how we account for external reconstruction and merger. Remember, I've said in terms of how we account for these two types of reconstruction, we account for them in the same way because we have said there is a similarity. In case of external reconstruction, here we have said a company which has been making losses, assuming it is company A, then we have said this company will be liquidated and then its operation will be taken over by a new company, which, for example, will be known as company B. In case of merger, we are saying if these two companies, company A and company B, have been making losses for a number of years or experiencing financial distress, the shareholders and directors will agree to liquidate the two companies, company A and company B, and the operation taken over by a new company, say company C. So that's why we are saying there is a similarity. In both cases, a company or companies liquidated, and then a new company will be formed to take over the operations, the business operation, asset and liabilities of the old company. So let's look on the accounting entries which are made. Accounting entries made to account for external and reconstruction or merger. The first thing here which is important for you to note is that we make two sets of accounting entries. The first set of accounting entries is meant to cross off the books of account of the old company which is to be liquidated, and the other set of accounting entries is made to open the books of account of the new company. And they open the books of account of the new company. Therefore, in this case, we can start by looking on the accounting entries. So now, here we can start by looking on the accounting entries. Accounting entries in the books of accounts. Books of accounts of the old company. The old company, in other terms, we refer to that as the selling company. The selling company. So mean that assuming we have a company A, and this company has been making losses for a number of years or experiencing financial distress, and the shareholders of this company, together with the directors, have resolved to liquidate that company and its operation, asset and liabilities to be taken over by a new company which is known as company B. So therefore this company, we are saying it is the old company. In other terms, because it is selling its business, asset and liabilities to company B, we can refer to that company also as the selling company, whereas this is known as the new company and also known as the purchasing company. The purchasing company, it is acquiring, it is purchasing the business of company what? A. So in this case, we are saying we make two sets of accounting entries. The first set of accounting entries is meant to cross off the books of account of this company, because by the end of the day that company is being liquidated. And the other set of accounting entries is to open the books of account of the new or purchasing company. So I want us we start by looking on the accounting entries made to cross off the books of account of the selling company. So the first set of the first accounting entry is the accounting entry which is made with respect to, or we can look on the accounting entries which is made to account for what? For the asset taken over. So we can talk of the accounting entries with respect to the asset taken over by new company. Asset taken over by new company. So with the asset taken over by the new company, so how do we account for these particular assets? So we debit an account which is called realization. It is also important here to note that when crossing off the books of account of the old or the selling company, the main account which is prepared is known as the realization account. So we debit the realization account, and then what we do is that we credit the specific asset account, specific assets accounts, and basically we do this with the net book value of the assets, with the net book value or the carrying amount of the asset. The carrying amount is the amount at which now the assets of the old company were recorded in the statement of financial position of the old company, because in most of the cases, whenever these assets are to be taken over by the new company will take over those particular assets at their fair value, at their current market value. But when crossing off those particular asset account in the books of account of the old company or the selling company, we do that using the net book value of those particular assets. Number two, we have those fictitious assets. So we can talk of with the fictitious assets, asset not transferred to new company. When talk about fictitious asset, these are assets which do not have physical existence. They are like imaginary assets. These include assets such as goodwill, patent rights, what if as the copyright. Mostly those particular fictitious assets will not be transferred to the new company, but they are supposed to be written off. So with the fictitious asset not transferred to the new company but written off, so how, in terms of how we account for that, we debit something called the ordinary shareholders, salary members account, and then we credit specific asset account. We credit specific assets account, and then from there we have now we can talk of the liabilities. The liabilities taken over by the new company, new company. So how do we account for those particular liabilities taken over by the new company? We debit the specific liabilities account, and then we credit the realization account. We credit the realization account. That is now to account for the liabilities which are taken over. It is also important for you to note that when the liabilities are transferred to the new company, the liabilities are always transferred to at their book value. Liabilities are not revalued like assets. assets can be revalued to their fair value, but liabilities cannot be revalued. If the old company had a bank overdraft of 2 million, that has to be transferred or has to be taken over by the new company at that value of 2 million. The new company cannot revalue a liability, cannot revalue something like what? Like a bank overdraft. So then from there, number 4, we can look on the accounting entry for the for the liabilities. I think we have talked about the liabilities which were taken over. Let's look on the accounting entry for purchase consideration agreed. So purchase consideration as agreed. So the purchase consideration, basically this is the amount of money which is supposed to be paid to the shareholders of this company. The shareholders of this company and also the financiers of this company, like the debenture holders and so on, they have accepted to sell their business. So they must be paid some amount of money. So with that particular purchase consideration agreed, so we debit which account? We debit now an account which is called the purchasing company account. Purchasing company account, and then we credit an account which is called realization account. Realization account. So that is the other accounting entry. The other accounting entry is with the liquidation cost. Liquidation cost incurred and paid. Incurred and paid. Such liquidation cost is debited in the account called the realization account, and then credited in the bank account. Credited in the bank account. Credited in the bank account. And then the other accounting entry number 6, we can talk of to transfer ordinary share capital and reserves, ordinary share capital and reserves to an account which is called ordinary shareholders salary members account. There is an account we mentioned here which is called ordinary shareholders salary members account. Account. So what do? We debit the ordinary share capital account stroke the reserves account. The reserves account, and then we credit ordinary shareholders salary members account. Salary members account. So mean that the ordinary share capital and all reserves you're talking of share premium, revaluation reserve and so on, they should be crossed off to an account called ordinary shareholder salary members account. To do that, we debit the ordinary share capital or the reserves account, and then we credit now that particular account which is called what? The ordinary shareholder salary members account. Then the other accounting entry we can say to transfer preference share capital to preference shareholders salary members account. Salary members account. So what do? We debit preference share capital account. Preference share capital account, and then we credit now this account called the preference shareholders salary members account. Salary members what? Account. And then from there we also need to account for the preference dividends in arrears. Preference dividends in arrears. So these are the preference dividends this company had not been paid. So how do we account for such preference dividends in arrears? We debit the realization account. Debit realization account, and then credit preference share holders salary members account. Salary members what? Account. So these are the main accounting entries which are made in order to do what? To cross off the books of accounts of the selling company. Of the selling what? Company. Therefore, from the journal entries which we have here, we can say that we have 3 main accounts which are prepared when crossing off the books of account of the selling or the old company. The first account is the account which is called what? the realization account. The other account is the account called the ordinary shareholders sundry members account, and also we have another account called preference shareholders sundry members what account. In fact, once you come across a question from this particular area here, a question testing on external reconstruction or merger, mostly the examiner will require you to prepare those three accounts: realization account, the ordinary shareholder sundry members account, the preference shareholders sundry members what account. So therefore, those are the three accounts now which are prepared. Then next, I want us to look on the accounting entries now which are made in order to open the books of account of the new what company. So let's look on that. So accounting entries in the books of account of the new company. So these are the accounting entries in the books of accounts of a purchasing company. Purchasing company. The purchasing company is the same with the new company. So this is the company which has been formed to take over the business operation asset and liabilities of the old company. So here we make like three main set of accounting entries, or basically we account for like three items. One, we account for assets which are taken over. We can say with the asset taken over at their fair value, with the assets taken over at fair value. So the new company will always take over the asset at their fair value, at their current market value. So those particular assets are debited in the specific asset account, and then we credit an account called business purchase account. Business purchase account, and basically we do that with the fair value. The fair value is the current market value of those particular assets. Number two, we also account for the liabilities taken over. So we can talk over with liabilities taken over. So how do we account for those particular liabilities? So first of all, we debit the account which is called the business purchase account. And then we credit the liabilities account. Remember, in this case, we said that when the liabilities are transferred or are taken over by the new company, they will be taken over at their book value. And then from there, we also account for purchase consideration agreed. With the purchase consideration as agreed, purchase consideration as agreed. So we debit the account which is called business purchase account, and then we credit something called the selling company account. And then after making those three journal entries, the journal entry as far as the asset is concerned, the journal entry for asset, journal entry for the liabilities, and also the purchase consideration, we prepare this account called the business purchase account to determine whether the new company acquired the business of the old company at a goodwill or negative what? A goodwill. So therefore, a business purchase account must be prepared. A business purchase account. And what is recorded in this account is what we have here. So with the asset which will be taken over by the new company, we are saying those particular assets in this account, they will be credited. This account is credited with assets taken over at their fair value, assets taken over at their fair value. And then for the liabilities which are taken over, we are saying they will be debited in this account. They will be debited in this account. These are the liabilities which were taken over. And then what we also record in this particular account here is the purchase consideration, which we are saying will also be debited in this account. Purchase consideration agreed. And then from there, what we do, we balance that account, and this account always will be having a balancing figure. A balancing figure on the credit side is a goodwill. Arising from acquisition or purchase of the business of the old company. But a balancing figure on this side, that is on the debit side, these are capital reserve. Capital reserve. And this particular capital reserve is taken to the statement of financial position of the new company as a component of equity. This goodwill is also taken to the statement of a financial position of the new company as a component of non-current asset. Asset. So these are the three main accounting entries which are made to open the books of account of what? Of the new company, or basically the purchasing what? A company. So before we look on an illustration as far as this is concerned, I want us to look on briefly how this particular purchase consideration is determined. So we can look on the methods of determining the purchase consideration. So methods of determining purchase consideration. Remember, you have said purchase consideration is that amount of money to be paid by the new company, by the purchasing company, as a result of acquiring the business of the old what? Company. So there are three methods which may be used in terms of determining this purchase consideration. The first method is known as the net asset method. So in this case here, the purchase consideration to be paid to the shareholders and the other financials of the old company is always equal to the total asset which were taken over at their fair value minus the liabilities taken over. So we take the asset taken over at their fair value minus the liabilities which were taken over. Any difference is the purchase consideration. The other method is known as lump sum method. And under this particular method here, the purchase consideration is agreed as a lump sum amount. It means that the owners of the new company will have to sit down with the shareholders of the old company and agree on a lump sum figure which will be paid to them as a purchase consideration. So therefore, in this case, we are saying the purchase consideration is agreed as a lump sum amount. And the last method of determining the purchase consideration is known as the net payment method. So under this particular method here, the purchase consideration is equal to the total payments, made to all shareholders, and financiers of old company. So the purchase consideration here we are saying will be equal to the total payment which was made to the shareholders and the financials of the old company. And actually, this is the common method which is used in all questions which are tested in the past papers. So all the questions tested in the past papers require you compute the purchase consideration by doing what? By using the net payment method. But in this case, I've said we have those as the three methods which can be used in terms of doing what? In terms of determining the purchase consideration. So here is today's assignment. Question number 1, define merger and external reconstruction. Question 2, differentiate between external reconstruction and internal reconstruction by giving 5 differences. Question 3, explain the conditions to be fulfilled by a company before undertaking internal reconstruction. I want us to stop at that point. Once we come back in our next session, I want us to look on an illustration question regarding how we account for external reconstruction and merger, which will be based on a past paper question. So see you in the next session.